Memory stocks have basically doubled this year, with the biggest names passing $1 trillion valuations. Behind this huge run is a shortage in one part of AI hardware that the entire build-out depends on, and that's memory. And there's a new ETF on the market called DRAM that holds the company at the center of that shortage. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. Let's talk about memory, the one thing that AI can't run without. At the heart of AI hardware, there's two critical pieces: processors, which do the computing to provide the power to complete AI tasks, and then memory to store and keep the processors fed with data. And as the AI chips get faster and more powerful, they need more memory capacity and bandwidth to keep up. So it's no wonder why memory has become one of the biggest bottlenecks in the AI build-out. But memory isn't just one single thing, there's a variety of different types. HDDs, or hard disk drives, are a type of non-volatile memory, which means it saves all your data even if the power is turned off. It's the lowest cost option for long-term data storage, and it's the slowest since it depends on mechanical spinning disks. NAND flash memory is another non-volatile memory that's used in SSDs, USB drives, and memory cards. It's faster than HDDs, and it's used to store huge amounts of training data, content that are used for AI systems, data centers, and more. These next two are considered volatile memory, which stores data when the power is on, but erases it once the power is turned off. And it's much faster than non-volatile when it comes to accessing and storing data. DRAM memory is even faster and is found in your computer, cell phone, and many other things. It's used to manage datasets, software, and CPU side tasks, but it's a bit too slow for high-performance AI workloads. And that's where HBM, or high bandwidth memory, comes into play. It stacks multiple DRAM layers together and is directly connected to the GPU. It uses less power, has more capacity, and provides high-speed memory access, which makes it critical for AI and data centers. So it's a better and faster way of packaging DRAM. This is why HBM is a main driver in AI technology today. It's the hardest to manufacture, and they've been selling out of production well ahead of time. On top of that, HBM manufacturing capacity takes years to build out. Expensive, limited, and essential are three words that explain why memory is one of the biggest stories in tech today. Now that you have a better understanding of memory, let's get into how DRAM works when it comes to the stocks that make it up. DRAM is built differently than other semiconductor ETFs since it only focuses on memory companies and not on the chip designers, equipment makers, or foundries. This is an actively managed fund, so it doesn't track an index, which means the portfolio managers are the ones that are picking the stocks. And there's a few different requirements for the stocks being chosen. First, at least 50% of its revenues or profits must come from the development or manufacturing of memory products. The different types of memory that it includes are what I covered earlier, like high bandwidth memory, or HBM, DRAM, NAND flash memory, NOR flash, and more. So it filters out the more diversified chip makers where memory is only a small segment or small portion of the business. The companies must also have a market cap greater than $10 billion and an average daily trading volume of at least $5 million. The fund is market cap weighted, so the larger companies are going to make up a larger portion of the fund. And there's a stock cap of 25% for any single company, and the fund is rebalanced every single quarter. For the fees, DRAM has an expense ratio of 0.65%, costing you $65 per year for every $10,000 invested. Let's now get into what stocks you're actually buying in DRAM. Jumping to the portfolio makeup, DRAM currently has 15 holdings in its portfolio, so it's very concentrated, with its top holdings in Micron, SK Hynix, Samsung, SanDisk, Western Digital, and a few others. And you can see the top three stocks make up a huge portion of nearly 75% of the fund. And since it's so concentrated, I think you should at least have an idea about the big names. The first and largest holding being Micron Technology. It's the only major US manufacturer of HBM, DRAM, and NAND flash. And it's one of the handful of companies that can supply memory at the scale that AI infrastructure demands. And the company has been rapidly expanding its HBM capacity for 2026 and has been sold out since early this year. Second, we have SK Hynix, which is a South Korean chip maker and is the leading supplier in HBM to AI chip manufacturers, making up roughly half of the market share, so it's a big player here. It also offers NAND flash, DRAM, and other memory products. Also, the company plans to list its shares in the US market, which could happen as soon as August this year. Third is Samsung Electronics, which I'm sure many of you are familiar with. Samsung is the largest memory chip maker by revenue, and it leads in both DRAM and NAND. They offer HBM as well, but it makes up a smaller portion of the share than SK Hynix. And even though Samsung is a big memory player, unlike the others, it's a diversified giant, offering smartphones, monitors, and many other consumer electronics, which are a big part of the business. The other names on the list focus on NAND flash, SSDs, hard drives, and more, which gives you the full exposure to the memory stack. DRAM's performance has been incredible, and it raises a real question. DRAM is a really new ETF, and it was created in April of this year, so just over 2 months ago. But in that time, it's managed to provide returns of well over 100%. This is one of the fastest runs by a new ETF, and it broke records to being the fastest ETF to cross $10 billion in assets, which is pretty crazy. Now, there wasn't just one event that caused this, but more so the sentiment and re-rating of the memory space. Since the AI and AI infrastructure build-out has been rapidly expanding, investors are no longer looking at memory as a commodity and instead as a critical asset. Each of the top 3 stocks in the fund crossed $1 trillion this year, and the amount of capital flowing into DRAM reflects the same change in sentiment. But this brings about an important question: is it too late to get in? Here's the reality: the forward earnings on companies like Micron and SK Hynix are still reasonable in comparison to many of the AI stocks that had a huge run. And the thesis remains: hyperscalers are spending hundreds of billions of dollars, HBM supply is sold out, and memory capacity takes years to build out. But investors that are buying today are buying after a huge gap up in the last 2 months. And the concentration that this fund comes with is a double-edged sword. With the heavyweight and the top 3 holdings and a small portfolio, things can go down just as fast as they've gone up on bad news or if sentiment changes. This doesn't mean that you should skip DRAM, but just be aware of the things that are going on. So where does DRAM go from here, and will the memory cycle turn? Let's first highlight the bull cases, which there are some hard points to ignore, which is that the memory supply shortage isn't expected to go away anytime soon. Samsung mentioned that memory shortages are expected to continue through at least 2027, with customers already locking in allocations for 2027. While the chairman of SK says the memory shortage will last until 2030, and NVIDIA CEO Jensen Huang is also expecting it to last a few years. HBM consumption is expected to continue growing strong, and new fab capacity can't come online fast enough to keep up. On top of that, spending on AI and AI infrastructure is expected to be around $765 billion this year alone, and growing to $1.6 trillion a year by 2031. It's no wonder why this period is being called the memory supercycle. We're still in the early stages of AI, but with the expansion into autonomous vehicles, quantum, robotics, and much more, there's the possibility that some reasonable level of demand could stay around for some time. But there are some fair points to consider on the other side. Memory has historically been a cyclical industry, where in the past, memory companies overinvested in capacity during the good times, then demand normalized, and then oversupply lowered prices, which led to the cycle spiraling downwards. In other words, to simply put it, there's a boom that drives heavy capital investment, and that capacity, which is production fabs, takes years to build. And not too long after things are up, the demand weakens and inventory is high, prices crash, and the memory names go down with it. This pattern is the same argument today. Who is to say that in 2 years we don't see the demand dry up? Or what if the huge spending from the hyperscalers slows down? Or if efficiencies improve, could memory demand slow down before capacity is added? There are some valid questions that no one is 100% certain about. And aside from the cycle, you have geopolitical risks. Most of the fund is exposed internationally, with the 2 largest companies, SK Hynix and Samsung, being South Korean. And this doesn't just affect memory, but it also affects the global semiconductor supply chain. So you could be exposed to risks from currency, tariffs, geopolitical tensions, or regulations. Not a big deal, but just something to keep in mind. But the AI infrastructure spending, memory capacity, and the global landscape will determine how this ultimately plays out. So, where does DRAM fit in a portfolio, and who is it for? First of all, DRAM is a very concentrated fund, so it should be a satellite position in your portfolio. It's not diversified and it focuses on a single layer within a single industry and it barely has any holdings. It's built this way, but that also means it's not a replacement for a broad market or tech sector ETF. It's going to come with more volatility and it's going to be 100% exposed to any memory news, whether it's good or bad. But there are a few reasons that you might want to invest in DRAM. The most obvious one is to get exposure to memory stocks. By investing in DRAM, you're getting exposure to stocks that you don't find in other semiconductor ETFs like SK Hynix and Samsung. Also, these stocks will likely have much smaller weights in other ETFs. Second would be that you believe in the memory story, and most importantly, that's the AI theme that is built on. This includes that if you think that AI capex spending will continue to grow and the ROI in spending will pay off and continue to fuel memory down the line. Next is for the growth potential of DRAM. If you think that it'll provide solid long-term growth potential from the expansion in AI and further advances in automation, robotics, medicine, and much more, where memory will still be a core component. This doesn't mean that DRAM will always go up and to the right, but you should be willing to accept the risk and volatility that the fund comes with. What if things slow down in the near term, or what if the memory cycle pattern comes back and we reach a tail end? And this fund is a little over 2 months old, so we don't know how it would look over different market conditions. This is something that you have to consider and be okay with. Now, if you want to learn about some more ETFs that give you exposure to the AI build-out, I talk about 6 of the best semiconductor and AI ETFs in this video here, or you can watch this video here on the best quantum ETFs. And if you made it this far, I really appreciate you watching, and don't forget to hit that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.